I'm 30 years old, I don't have a boss, and I play video games for fun because I handled my money right when it actually mattered. While most people my age were distracted in their 20s, I was quietly learning investing, personal finance, and how to build real freedom. This channel exists because nobody taught me this stuff, and I don't want that to be your story too. So let's get into it. Here are 5 proven strategies for investing $1,000 in 2026 that could transform your financial future. Whether you're looking for guaranteed returns in high-yield savings accounts or calculated risks with S&P 500 index funds and Roth IRA contributions in an AI-driven economy, this $1,000 represents your entry point into wealth building during one of the most interesting investment periods in recent history. Let me be direct about something. $1,000 isn't life-changing money today, but what you do with it absolutely can be. We're living in a unique moment where high-yield savings accounts are paying over 5% APY, the S&P 500 is projected to hit 8,100 by year-end, and institutional money is finally flowing into cryptocurrency. The investment landscape in 26 looks fundamentally different than it did just 2 years ago. The Federal Reserve has settled into a new normal with rates between 3.5 and 3.75% after 3 cuts in late 2025. Inflation has stabilized, but we are not returning to the 0% savings rates of the 2010s. Artificial intelligence has moved beyond hype into everyday utility, creating real revenue for companies that can harness it. And the psychological barriers around investing have never been lower thanks to fractional shares and zero commission brokerages. Here's what makes this moment special. Goldman Sachs is forecasting 2.8% global growth for 2026, beating consensus estimates. Morgan Stanley has set S&P 500 targets as high as 7,800, representing 14% gains, while Oppenheimer is even more bullish at 8,100. These aren't wild-eyed predictions from crypto Twitter. These are Wall Street's most conservative analysts saying 2026 could deliver double-digit returns. Now, before we dive into specific strategies, understand that whether you're investing through a traditional brokerage account, a Roth IRA, or even your 401k beyond your employer match, these principles apply. Personal finance expert Ramit Sethi, host of Netflix's How to Get Rich, emphasizes that successful investing starts with the fundamentals, and that's exactly what we'll cover. So what would I actually do with $1,000 right now? Let me walk you through 5 strategies, from ultra safe to calculated risk, that make sense given where we are today. Strategy 1, the emergency fund foundation. Before we talk about chasing returns, let's address the elephant in the room. If you don't have an emergency fund, that's your first move. And in 2206, this isn't about stuffing cash under your mattress at 0% interest. High-yield savings accounts are paying real money right now. We're talking up to 5.00% APY from institutions like VOO Money, 4.21% from Newtek Bank. To put that in perspective, the FDIC national average is just 0.39%. Your money in a high-yield savings account is earning more than 10 times the national average. Ramit Sethi puts it simply. Split your first $1,000, put $500 into a high-yield savings account as your emergency buffer. This prevents you from going into debt when life happens, and it's earning real returns while just sitting there. At 5% APY, that $500 grows to $525 in year 1 with zero risk. This isn't glamorous, and it won't make you rich overnight, but it's the foundation everything else is built on. I learned this the hard way. One unexpected expense can wipe out months of investing progress if you're not protected. Frankly, earning 5% of money you need to keep liquid is better than most people managed in the stock market last decade. American Express is offering 3.30% APY as of March 2026, and Ally Bank is at 3.2%. Still 8 times the national average. Even the boring option is paying meaningful returns in 26. Strategy 2, the index fund approach. Now we get to the wealth building part. The remaining $500 from Sethi's approach, or your full $1,000 if you already have emergency savings, goes into the market. The smartest way to do that in 2006 is still the same as it was in 1976, investing in the Vanguard S&P 500 ETF, ticker VOO, which tracks the S&P 500 with expense ratios under 0.10%. The Vanguard Total Stock Market ETF, ticker VTI, gives you ownership in more than 3,500 different companies with a single purchase. You're instantly diversified across every sector of the American economy. VOO was the largest ETF by assets under management in March 2026, and there's a reason for that. Here's the math that matters. Over the last 30 years, the S&P 500 has averaged annual returns of around 10%. A $1,000 investment growing at 10% annually becomes approximately $6,700 in 20 years. That's the power of compound growth. And it doesn't require you to pick the next Tesla or predict which AI company will dominate. This is exactly how I started building wealth in my early 20s, not with some genius stock pick, just boring index funds and consistency. As of March 2026, the Invesco QQQ Trust, which tracks the tech-heavy NASDAQ 100, had generated a total return of around 541% over the past decade. A $10,000 investment made 10 years ago would be worth more than $64,000 today. Your $1,000 would have become $6,400. What makes 2026 interesting for index fund investors is that Morgan Stanley's base case projects S&P 500 earnings per share growth of 14 to 16% in 26. Oppenheimer forecasts earnings per share of $305, up from $275 in 2025. If these projections hold, we're looking at one of the strongest earnings growth years in recent memory. The beauty of index fund investing is simplicity. Open a brokerage account with Charles Schwab or Fidelity, search for VOO or VTI, and buy $1,000 worth. If share prices are high, buy fractional shares, set up dollar cost averaging with even $50 monthly, and let compound growth do the work. Strategy 3, the Dividend Kings approach. Some of you are thinking about income, not just growth. Maybe you want to see actual cash hitting your account quarterly, or maybe you're nervous about volatility and want companies that have survived multiple recessions. This is where dividend investing makes sense. The data on dividend stocks is compelling. Over the last 50 years, dividend-paying companies outperform non-dividend payers by more than 2 to 1. 9.2% average annual total return versus 4.3% for companies that don't pay dividends. But the best performance came from dividend growers, companies that consistently increase their payouts year after year. Those delivered 10.2% returns versus 6.8% for companies with static dividend policies. In an uncertain environment, the best stocks might be the boring ones. Consumer staple dividend kings like Coca-Cola and Procter & Gamble have been paying and increasing dividends for decades. These companies survived the Great Depression, multiple recessions, and every market crash you can think of. A $1,000 investment gets you about 12 shares of Coca-Cola or 6 shares of Procter & Gamble as of March 2026. Either way, you're buying a well-run company with an attractive yield and a core business that isn't going anywhere. People will keep drinking Coke and using P&G products, regardless of what happens in the stock market. The Schwab US Dividend Equity ETF, ticker SHD, is considered one of the best dividend ETFs in the world. It gives you exposure to high-quality dividend-paying companies without having to pick individual stocks. Your $1,000 buys you a diversified portfolio of dividend champions, and you'll receive quarterly payments that you can reinvest or spend. Strategy 4, the AI revolution play. Now let's talk about the other elephant in the room. Artificial intelligence is reshaping entire industries, and the companies positioned to benefit could see explosive growth. But this requires careful selection because valuations are stretched and expectations are sky high. Taiwan Semiconductor Manufacturing, ticker TSM, has guidance showing overall revenue growth of nearly 30% in 2026. Even better, their AI chip revenue is expected to grow at a compound annual rate of nearly 60% from 2000 to 2009. This isn't speculation anymore. This is a company with actual AI customers paying real money for chips that enable everything from ChatGPT to autonomous vehicles. The Trade Desk remains a dominant advertising platform and grew revenue by 18% in Q3. Wall Street analysts expect 16% growth for 2026, and you can buy shares for 15x expected forward earnings. In a world where AI companies are trading at 50 times earnings, that's reasonable. Here's a name you probably haven't heard, Nebius. This company operates data centers filled with cutting-edge GPUs to power AI workloads. It's positioned for massive upside as AI demand continues growing, but it's flying under the radar compared to obvious plays like Nvidia. Let me be honest about the risks though. As we enter 2026, AI stocks require even stronger growth to support their valuations. Many forecasters expect AI growth over the next 5 years to be below what markets are currently pricing in. The margin for error is razor thin. If you go this route, limit your AI exposure to maybe $200 to $300 of your $1,000. This gives you upside participation without betting your entire investment on one theme. Strategy 5, the cryptocurrency allocation. This is where things get interesting. Bitcoin hit an all-time high over $126,000 in October 2025, then fell to lows around $80,000 in late 2025. By March 2026, it had stabilized, and industry experts are making bold predictions for the rest of the year. Standard Chartered's global head of digital asset research forecasts Bitcoin reaching $150,000 in 2006. CoinShares sees a range of $120,000 to $170,000, while Bitcoin Suisse suggests Bitcoin could approach $180,000. Even the conservative consensus puts the range at $120,000 to $175,000. What's different about crypto in 2026 is institutional adoption. With the approval of spot ETFs, pension funds and banks are now involved. This reduces some of the Wild West risks that defined earlier crypto cycles. The CIO of Bitwise Asset Management notes that the average Bitwise investor has about 2.5% of their portfolio in Bitcoin. The 20 millionth Bitcoin will be mined in March 2026, emphasizing the scarcity aspect that drives value. Meanwhile, regulatory clarity is improving. The Clarity Act, which seeks to create a framework for regulating digital assets, is expected to become law in 2006. Grayscale anticipates bipartisan crypto market structure legislation will bring deeper integration between public blockchains and traditional finance. But let's be realistic about allocation. A common rule of thumb is 5% of your portfolio in crypto. With $1,000 to invest, putting $50 to $100 into cryptocurrency offers exposure to potentially massive growth without risking your financial future. Stick to the blue chips, Bitcoin and Ethereum. These have survived multiple bear markets and have the strongest developer communities and institutional backing. You can buy them directly through Coinbase or invest in Bitcoin ETFs through your regular brokerage account. Before we wrap up, let's address something crucial, the debt reality check. If you have high interest debt, especially credit card debt, that becomes your highest return investment opportunity. Most credit cards charge 20% APR or higher, and even a personal loan might be costing you 10% annually. If you have a $5,000 personal loan at 10% APR, putting $1,000 toward the principal saves roughly $100 per year in interest. That's a guaranteed 10% return, better than most years in the stock market. Credit card debt is even more urgent. Paying off 20% APR debt is the equivalent of earning 20% risk-free in the market. I know it's not exciting. Paying off debt doesn't give you the thrill of watching your Bitcoin balance potentially double, but it's mathematically the smartest move when you're paying double-digit interest rates. So what would I actually do with $1,000 in 2026? Here's my personal allocation. $300 goes into a high-yield savings account earning 5% APY, covering unexpected expenses, without forcing me into debt. $500 goes into the Vanguard S&P 500 ETF, capturing the broad market upside that Morgan Stanley and Oppenheimer are projecting for 2026. $150 goes into a quality dividend ETF like SHD, providing income and stability in case market volatility increases. And $50 goes into Bitcoin, giving me exposure to potential explosive upside without risking money I can't afford to lose. This allocation gives me safety, growth, income, and a lottery ticket. More importantly, it's diversified across different asset classes and risk levels based on a proper risk tolerance assessment. The most important step, set up automatic investing through dollar cost averaging. Even if you can only add $50 monthly to your investments, that consistency matters more than any single $1,000 decision. Remember what Ramit Sethi said, if you think wealthy people have access to secret investments that get them 10 times the returns, you're wrong. Wealth building in 2206 isn't about finding the perfect stock or timing the market. It's about starting with what you have, staying consistent, and letting compound growth work in your favor. And I'm living proof of that. I'm 30 years old. I started with small amounts in my 20s. No inheritance, no lucky break. Just the decision to take money seriously while everyone else wasn't paying attention. If you made it to the end, thank you for watching. This channel is about investing, building real wealth, and reaching financial freedom before 30, so you can actually enjoy life later. If that sounds like the life you want, subscribe.